What if I told you that one of the largest economic losses in modern American history didn't happen on Wall Street, didn't happen during a financial crash, and didn't happen because of a natural disaster, but happened quietly across farm fields, silos, and rural towns all over the United States? Over $34 billion. Gone. Not stolen, not mismanaged. Lost because of trade policy decisions that were supposed to make America stronger. And now, after all of that, the solution being offered is $12 billion in aid, barely a third of the damage. Today, we're breaking down how American farmers lost over $34 billion, why the aid package doesn't come close to fixing the problem, and how this story quietly connects to GDP growth, global trade power, consumer confidence, and even why money has been flooding into gold, silver, stocks, and government debt. Stay with me, because by the end of this video, you'll understand why this isn't just a farming story, it's a warning signal for the entire economy. To understand how we got here, you have to rewind to the moment trade policy became a weapon instead of a tool. When tariffs were rolled out under the Trump administration, the promise was simple and emotionally powerful. Protect American industry, punish unfair trade practices, bring jobs back home. And on the surface, tariffs sound logical. Tax foreign imports so domestic producers gain an advantage, force other countries to negotiate better deals. But what sounds strong in a political speech often behaves very differently in the real economy, because tariffs don't exist in a vacuum. They provoke retaliation. And when retaliation happens, the first targets are almost never tech companies or luxury brands. They are politically sensitive exports, things like soybeans, corn, wheat, pork, and dairy, things grown by farmers who depend on global markets to survive. Before the trade war, American farmers were deeply tied into the global economy. China alone bought more than half of all U.S. soybean exports. Entire farming regions were economically synchronized with overseas demand. Crops were planted months or years in advance based on long-standing trade relationships. And then, almost overnight, retaliatory tariffs hit. Chinese buyers turned away from U.S. soybeans and locked in long-term contracts with Brazil and Argentina. Europe imposed barriers, other nations followed. And suddenly, American farmers weren't just dealing with lower prices, they were dealing with disappearing buyers. This is the part most people don't understand. When a factory loses business, it can sometimes pivot. When a farmer loses an export market, the crops are already in the ground, the equipment loans are already signed. The fertilizer, fuel, seed, and labor costs are already paid. Farming is a business where timing is everything, and trade policy shock hits at the worst possible moment, after the investment but before the sale. As export demand collapsed, supply piled up inside the United States. Grain elevators filled, storage costs rose, and prices fell hard. Soybean prices dropped. Corn prices weakened. Wheat struggled. The market did what markets always do when supply overwhelms demand. It crushed margins. For many farmers, prices fell below the cost of production. That means every acre planted was generating a loss, and that loss compounded month after month, season after season. This is how you get to $34 billion. Not in one dramatic moment, but through thousands of small losses repeated across millions of acres. Now, here's where the story gets even more complicated. The Trump administration responded with aid payments. The logic was simple. If trade policy caused pain, the government would step in to help farmers survive until better deals were reached. And to be clear, those payments did help some farmers stay afloat. They prevented immediate collapse, but they did not restore markets. They did not rebuild trade relationships. And they did not compensate for the full scale of the damage. $12 billion sounds enormous until you place it next to a $34 billion loss. And even that $34 billion figure is conservative. Some estimates put total losses closer to 40 or even 44 billion when you include secondary effects, long-term contract losses, and price suppression that lingers even after tariffs are lifted. Aid payments, meanwhile, are temporary. They are capped. They are unevenly distributed, and they do not scale with ongoing damage. This creates a dangerous illusion. On paper, it looks like farmers are being helped. Politically, it sounds like a win, but economically, it functions like putting a bandage on a structural fracture. Because the real damage isn't just lost income, it's lost position in the global market. When China shifted its soybean supply chain to Brazil, it didn't do so temporarily. Infrastructure investments followed, ports expanded, logistics improved, trade relationships deepened. Even if tariffs disappeared tomorrow, those buyers are no longer waiting for the U.S. to come back. They've moved on. And this is where the ripple effects begin. Agriculture isn't a niche sector. It feeds into transportation, equipment manufacturing, fuel demand, chemical production, food processing, and rural banking. When farmers lose money, they delay equipment purchases. Tractor sales slow, equipment manufacturers cut forecasts, transport companies see fewer shipments, local banks carry higher credit risk, rural employment weakens, and suddenly, what looked like a contained trade dispute becomes a drag on regional economies. Zoom out even further, and the macroeconomic effects start to show. Agricultural exports are a major contributor to U.S. trade balance. When exports fall, trade deficits widen. When trade deficits widen, GDP growth takes a hit. And when GDP growth slows, consumer confidence follows. People spend less when they sense instability, even if they don't fully understand where it's coming from. This is how a farm crisis quietly bleeds into the broader economy. Now here's where things get really interesting, especially if you're an investor. Because while farmers were losing billions, something else was happening in the financial markets. As trade uncertainty increased, money started moving. Capital hates uncertainty, but it loves protection. And when investors sense rising geopolitical risk, trade instability, and slowing growth, they reposition. Historically, that means increased interest in safe haven assets: gold, silver, government bonds. Look at the timing. Periods of heightened trade tension often coincide with rising precious metals prices. That's not coincidence. Gold and silver don't just respond to inflation, they respond to confidence. When faith in economic stability weakens, metals shine. The same trade policies that crushed farm exports also contributed to market volatility, currency fluctuations, and uncertainty around global growth. That uncertainty pushed money into assets designed to preserve value rather than generate growth. At the same time, stock markets behaved in a split personality. Some sectors benefited from tariffs, others suffered. Agricultural equipment stocks lagged, food processors faced margin pressure. Meanwhile, defense stocks, domestic manufacturers, and companies insulated from global trade sometimes surged. This created a distorted market landscape, where gains in one area masked losses in another. On the surface, everything looked fine. Underneath, structural damage was building. Debt markets tell another part of the story. As farm incomes fell, borrowing increased. Farmers took on more debt just to operate. Operating loans grew. Refinancing became common. That debt doesn't disappear, it accumulates. And when an entire sector carries elevated debt levels, lenders adjust. Credit tightens. Interest rates rise for riskier borrowers. That affects not just farmers, but small businesses in rural areas that depend on the same financial institutions. This is how trade policy reaches places it was never meant to touch. A tariff on soybeans turns into higher borrowing costs. Lost exports turn into delayed capital investment. Reduced confidence turns into increased demand for safe haven assets. And all of it flows through the economy like a slow-moving current, largely invisible unless you know where to look. What makes this situation especially dangerous is that aid payments can actually delay recognition of the problem. When government checks arrive, they soften the blow enough to prevent immediate collapse, but not enough to restore growth. That creates stagnation. Farms survive, but they don't thrive. Innovation slows, expansion stops, and the sector becomes more dependent on future aid rather than competitive strength. From an investor's perspective, this matters more than headlines suggest. Agriculture is often an early indicator. When farmers are struggling, it usually means global demand is shifting, trade routes are changing, economic power is moving. Ignoring that signal is how investors get blindsided later by broader slowdowns. There's also a political feedback loop at play. Aid programs grow when losses grow. That increases government spending. Increased spending contributes to deficits. Deficits increase government debt issuance. And increased debt issuance affects bond markets. Yields shift, currency values adjust. And suddenly a trade policy decision becomes a factor in long-term fiscal stability. Now ask yourself this question. If $12 billion can't fix a $34 billion problem, what happens next year and the year after that? Because trade relationships aren't rebuilt overnight. Market share isn't regained instantly. And once global buyers diversify away from you, they rarely come back in full. This is why many economists argue that the real cost of the trade war isn't what's already happened. It's what's locked in. Lost contracts, altered supply chains, reduced influence. Those are costs that don't show up neatly in quarterly reports, but they shape economic reality for decades. And here's the cliffhanger most people miss. Even if tariffs are rolled back, even if aid increases, even if prices recover slightly, the structure has changed. American farmers are now operating in a world where global buyers know they can't rely on stable U.S. trade policy. That uncertainty gets priced in permanently. Lower bids, shorter contracts, higher risk premiums, and that means lower long-term profitability. So when you hear about $12 billion in aid, don't think of it as compensation. Think of it as a signal flare, a sign that the system absorbed damage it couldn't otherwise survive. When systems start relying on emergency support, investors should pay attention, because money flows tell the truth before narratives do. When gold rises during trade disputes, it's not fear, it's calculation. When bond demand increases, it's not panic, it's positioning. When agricultural land values flatten despite inflation, it's not coincidence, it's lost confidence in future earnings. This story isn't about politics, it's about consequences. Trade policy doesn't just punish foreign competitors, it reshapes domestic industries in ways that can't always be undone. And the $34 billion farmers lost isn't just their loss. It's a subtraction from the entire economic system. So the next time you hear about tariffs or aid packages or trade negotiations, remember this. The damage is rarely where the cameras are pointed. It's in the fields, the contracts, the debt ledgers, and the market signals most people never connect. And by the time those signals reach the stock market, the opportunity or the risk has already arrived. If you want to understand where the economy is going, don't just watch Wall Street, watch the farmers. Because right now, they're telling us something very important, and most people aren't listening. And before anyone rushes to point fingers, let's pause and say this clearly because it matters. This is not a story about farmers making bad decisions. This is not a story about inefficiency, stubbornness, or failure to adapt. American farmers did exactly what the system asked of them. They planted, they invested, they produced, they fed the country and supplied the world. They didn't speculate recklessly. They didn't gamble on leverage. They followed demand signals that had been stable for decades. And then those signals were yanked away by policy decisions far beyond their control. Farmers didn't lose $34 billion because they misread the market. They lost it because the market was fundamentally altered after they had already committed their capital, their labor, and their land. That distinction matters because blaming farmers for trade policy fallout is like blaming firefighters for a fire they were sent into without water. So what does smart advice look like in an environment like this? One where policy risk can erase entire export markets overnight? First, survival now beats growth later. That's not pessimism, it's strategy. Farmers who preserve liquidity, protect working capital, and resist pressure to overexpand are positioning themselves to outlast volatility. In a world where trade rules can change with a headline, resilience is worth more than scale. Second, dependence is the real enemy. Not dependence on farming, but dependence on a single buyer, a single export route, or a single assumption about global trade stability. Farmers who explore regional supply chains, value-added production, specialty markets, or even partial direct-to-consumer models are not giving up. They're insulating themselves. Diversification isn't abandoning tradition, it's defending it. Third, information is no longer optional. Farmers don't need to become traders or economists, but understanding macro signals, currency moves, export data, trade negotiations, interest rate trends has become part of modern farm management. Because the days when politics stayed out of pricing are over. Awareness doesn't eliminate risk, but ignorance magnifies it. Fourth, unity matters more than ever. Individual farmers don't negotiate trade deals, but organized voices shape policy outcomes. When the people absorbing the losses remain quiet, decisions are made in abstraction. When their realities are visible, pressure builds for structural solutions instead of temporary relief checks. And let's talk honestly about those checks. Aid payments are not generosity. They are acknowledgement. A quiet admission that the system caused damage it could not absorb on its own. Farmers don't want to live on government assistance. They want markets. They want stability. They want to compete. They want to sell what they grow at a fair price without wondering which election cycle might erase their buyers next. The truth is, farmers have been acting as economic shock absorbers for years. They absorbed price collapses. They absorbed tariff retaliation. They absorbed delayed payments. They absorbed debt. And they kept producing anyway. That's not weakness. That's resilience bordering on sacrifice. And here's the thought that should stay with you long after this video ends. When a sector this essential starts relying on emergency support to survive, the problem isn't the sector. It's the structure around it. Because agriculture isn't a side story, it's foundational. It feeds supply chains. It anchors rural economies. It stabilizes food prices. It underpins exports. And when it weakens, the effects don't stop at the farm gate. They ripple into banks, markets, currencies, and confidence itself. So when you see gold rising during trade disputes, understand why. When you see debt issuance climbing, understand where it starts. When you see confidence slipping, understand who felt it first. Farmers are not behind the economy. They are ahead of it. They feel the pressure before the data prints. They see the damage before the headlines. And right now, they are telling us something uncomfortable but vital. Stability matters more than slogans, and markets matter more than messaging. So don't just watch stock charts. Don't just listen to speeches. Watch the fields. Watch the export numbers. Watch who is absorbing the cost of decisions made far away from the consequences. Because long before an economy breaks on Wall Street, it fractures quietly in places most people never look. And that's why this isn't just a farming story, it's an early warning. Subscribe for weekly macro insights.